and what your commission fees are. Well, those aren't the only income generating strategies. What about iron butterflies? Well, iron butterflies is similar to an iron condor, and an iron condor will combine a bull put credit spread and a bear call credit spread. So we'll have two short options that are out of the money and two long options, calls and puts, that are further out in time. With the iron butterflies, I'm going to sell a call and sell a put at the same strike price. So I'm trying to pinpoint a strike price. Now that's really hard to do, which is one of the reasons why I don't trade iron butterflies in my personal account. And I have a joke with the customers that call me up for a coaching session who are trading iron butterflies and short straddles. And I tell them, hey, if you're able to pinpoint a strike price with accuracy every month of where a stock or an index is going to be trading, you're probably not calling me for help. I should start calling you for help. It's really hard to just pinpoint a strike price. But now that we're not dealing with a standard expiration that might be 4 or 5 weeks out in time, depending when our previous expiration was, maybe it's easier to do the iron butterflies with a shorter time frame, 7 days. Something that can be done. It's not what I recommend doing. Short straddles, same as above. It's hard to pinpoint a strike price, but you have a shorter time frame now, so it might be easier to apply that trade with the weekly options. Now, short strangles, this is similar to the iron condor, but without the long wings on the outside. A short strangle, if I have a stock at 50, for example, I might sell the out-of-the-money 45 put and sell the out-of-the-money 55 call. As long as the stock stays below 55 and above 45, both my call and put would expire worthless and we keep the premium. The problem there is that if it really has a significant gap up or gap down, I don't have any protection on the outside wings on a short strangle. I technically have infinite risk on the upside and the downside, although I do have a wide range of profitability. That's why most investors who will approach a short strangle will instead use an iron condor with the weekly options or with the standard options, because in the iron condor I might still have the same short put and the same short call, but on the outside I've purchased a long call and a long put that's further out of the money, so my risk is limited. And when we go into the iron condor, we'll talk about that a little bit more. Now, some of the techniques and strategies that you might be able to have fun with that might be more advanced using the weekly options are, for example, collar spreads. A collar or long collar is typically defined as any position where you buy stock, sell a call, and buy a put. Now, for those of you who are familiar with my trading style, what I present and what I discuss during the other free webinars we host during the week, I'm a fan of using what are called standard collars. And a standard collar is, again, let's say we have our stock trading at $49 per share. I'd buy shares of stock at $49, sell an August 50 strike call that's just at or slightly out of the money, and at the same time I might buy the August 47.5 put or the August 45 put, depending on my preference for risk and reward. So I have the same month to expiration. I've sold an at to slightly out of the money call and bought an at to out of the money put. Well, if the premium's good, I could do that with a weekly option. I could buy shares of, let's say, Barrick Gold today. I could sell the 100 call. Barrick Gold, I'm sorry, is roughly around $97 per share. So I might buy shares of stock at 97, sell the weekly 100 strike call, and buy the weekly, let's say, 95 put or 90 put, depending on my risk-reward tolerance. But you can also do sort of a hybrid collar, where I could buy, let's say, shares of Barrick Gold at 97, buy the standard August expiration that expires in about 29 days, the 90 strike put, and sell the weekly call against it month by month, or week by week by week. So I've got the standard August put option as my protection, and I'm selling the near-term weeklies every week to generate premium rather than selling the August call right away. Now, calendar spreads, naturally this applies to that as well. A gentleman I had a discussion with at the OIC at 888options.com, he said that one interesting thing he's heard is using calendar spreads. Now, I don't know how many of you are familiar with horizontal or diagonal spreads. I would prefer to do this with diagonal spreads. In a diagonal calendar spread, I would treat it similar to a covered call, but what I'm going to do is, if Barrick Gold again at $97, I might buy the far out in time, let's say January 2011, in the money call. Let's say the 90 strike call or the 95 strike call. So I'm in the money and I'm far out in time. And at the same time, I'm going to sell that at or out of the money August call against it. And my hope is that the stock kind of stays right around 100 or a little bit below 100 at August expiration. I keep most of the premium for the call I've sold, and then I'll go ahead and sell the September 100 call or the 105, depending on where the stock had moved to at that point. Well, could I use a calendar spread by, let's say, buying an August or September call on Barrick Gold that's in the money, and then trying to sell the weekly option against it, the out of the money or at the money weekly option, every 7 days? Well, yes, I could. We could do that as well. So there are different variations that you can use, but you really want to focus on the income generating strategies if you're going to use the weekly options, in my opinion. Of course, you can use the long positions as well, but I just don't think you have enough time for the stock to move in your desired direction or the index to move in your desired direction to make a decent premium. All right, so how do we identify weekly options on power options? Well, the first simple way is we can just use the options chain. We can pull them up by symbol just to view the weekly options that are available. We can use the search by symbol tool in a given strategy to view the different combinations on a weekly option, one stock at a time, or we can use the search tool to really customize the positions and the criteria that we want to use for the weekly options in our strategy. And then, of course, we're also going to use the portfolio tools to track the positions just as we would with any standard expiration option, view the rollout opportunities and potential income methods or adjustments as we get closer to our weekly expiration. So let's go ahead and apply that. Let's navigate over to the Power Options tools. I'm just going to pull up our webinar account here, the main trial account. Now I've already selected on the top of my screen just to have some of the basic income generating strategies we discussed available. Covered call, naked put, our two vertical credit spreads, the iron condor, and of course we talked a little bit about the collar and the calendar call. With using the screening tools, I'm going to focus mostly on the credit spreads and the iron condors, and then I'm going to talk a little bit about what we discussed with the collars and the calendar calls. But when we started, if I just wanted to look up the weekly options on any of the available stocks or the indexes, to start, we'll just type in the symbol field. So let's go ahead and pull up $SPX. This is the S&P 500 index, and we want to use the $ on power options. And I'll simply click chain. So this will take me to the 5-strike call and put chain for the S&P 500. And you see we have our various weekly options. Here are calls. And over on the right we have our puts, the different bid price versus the ask price, the implied volatility, and some other information is selected here as well. The % naked yield. This, by the way, is one of the reasons, and we'll take a look at that at the stock. While naked puts and covered calls can be used with the weekly option, but the yield is smaller. Now, if I do this, for example, we have a 0.4% naked yield. This is if I sold the 1100 put option on SPX as a naked put position. Now, if I did that 4 times in a row, I might have a yield of 1.6%, and that is for the 1100 position. But you see here, if I just went ahead and sold the August directly with 26 days to expiration, scroll down a little bit further here, the % naked yield for the 1110, oh, I'm sorry, I'm looking at the wrong one, aren't I? I apologize.